Hi, today's topic is how to value your business within minutes and be able to quantify and value all asset types, namely tangible assets and intangible assets. This methodology is provable when most others are not. This type of valuation methodology complies with the law. Most other reports do not. This valuation can be done in minutes, and you can decide the accuracy or not. This method is open and transparent, and the others are not. With this method, the reader can locate and recognize errors at a glance, the graphic format. This method is faster than any others, and you do not have to wait until the preparation of financials. Most reports are flawed and, if challenged, will fall apart. They deny the existence of truth. In other words, tangible assets recognition, or they do not feature in their report. Accounting concepts have gone the way of the dodo bird. They are not relevant today and cannot keep pace with market activities that rely on speed and technology. They have only recently decided the following, and according to AASB 78, it states that active markets cannot exist for brands, mastheads, publishing rights, patents and trademarks because each asset is unique. Transactions do not occur in a very competitive market. They are relatively infrequent and often not public. What utter bunkum. People buy and sell domain names all the time. People trade publishing rights, music and other intangibles all the time. Accounting standards are becoming irrelevant. This is only one problem they have of many. There are two worlds out there. One gets its information from market activity, which is required by law, and the other sits at a desk and interprets individual financials, manipulates them by rearranging expenses, and produces a flawed and misleading result. And they get that from guesswork. There is no market comparison whatsoever. Now, the biggest threat to business valuation practice is accrual accounting. Why? Because it includes money not yet received in its financials, accounts receivable. Plus, there are many other reasons, all to do with non-cash flow items and recognition of work in progress and false numbers or non-market numbers in the balance sheets, such as liabilities or concepts such as WACC, or weighted average cost of capital. I recommend you using real incomes and real expenses. So let's consider some examples. Now, given the example on your screen, which business is worth more? Careful, if you chose business B, your focus is on the wrong numbers. The businesses have the same intangible asset value. Debt is a management issue and does not relate to market values whatsoever. Right, the next example on your screen is discounting. Now, which business is worth more? You do not have to be Einstein to figure this out. Business A is worth more than business B. It does not matter diddly squat what the net profit is. You must know how the income is created and who it belongs to and the margins it creates. It is impossible to value business unless you profile and benchmark turnover. Turnover must be transferable to have value, and it is the only number related to markets. Rearranging expenses to produce value is flawed. It is amazing that some claim they are in the pursuit of excellence, yet they follow a path of insanity. Next, we have the issue of key personnel or related parties. In order to value any business, you must be able to value all asset types or components. Using the business valuation worksheet, all you need to do is fill in the spaces. The only item that needs external input is to find the multiplier from market comparison And to value any business, you must be able to profile turnover and benchmark your business numbers compared to industry standards. Then simply add them up to produce a result. But first, some background knowledge that will give you greater understanding as to the support or lack of it for values. The business world is made up of three economic entities: public companies, which represent less than 0.01%, and most news reports focus on the share market activity. Economic private businesses, they make up about 4.99%, and lifestyle businesses make up the other 95%. Business statistics tell us there are three types. You decide which one you are in, and you will know where to look for values. You're either in retail, industry, or service, and you can figure that out. You need to be able to plot the value and activity of your business in past and present real times. If changes occur, particularly negative changes, you must be able to react quickly, identify them, and affect changes. Now, the funnel effect, by using this, this will put you in the ballpark based on an economic rational person concept. And basically, it's what a rational person would do or pay. Understanding margins through trading will allow you to value all cash flows created by businesses and their acceptance or desirability in the marketplace. Now, the ones at the top of the tree are worth a lot more than the ones in the bottom of the tree. Valuing your revenue streams by placing a rate in the dollar based on market comparison is the best way to understand values. If you are in the lower part of the tree, your rate in the dollar will be lower. If you are in the higher part of the tree, your rate in the dollar will be higher. And that's quite clear. The lower part of the tree, a lot more competition. I recommend you look at the world's fastest one-page business calculator, and you can know the value of your business within minutes. Simply click on the link in the video description below. That concludes today's presentation. All this content can be found at valuationworld.org. Thanks for watching.